Happy New Year and welcome to Citi Market Watch, where we concisely unpack all you need to know on important topics. This is now our third year, and so thank you for your continued support. Joining me, Audrey Cheong, Citigold Private Client Portfolio Counsellor.
Happy New Year.
It has been an awful few years with significant events derailing the outlook. And not to start on a negative footing, but we now walk into 2023 with the majority of commentators, strategists, and the market expecting a US recession. It is arguably the most forecasted recession in history. So, Audrey, the question really is not necessarily what is priced in, but what is not being priced in.
That's a fair point, son. Broadly, Citi and consensus expects the Fed to raise its Fed funds rate to between 5 to 5.5% and actually hold it throughout most of 2023. Our expectation, therefore, is for US unemployment to rise further, dampening demand to ensure that US inflation comes down and stays down. And on the back of a slowing US economy, the expectation is for earnings to also fall about 10%, and hence the immediate outlook for US equities is for weakness or another leg lower.
And adding to that, Europe continues to struggle with its recession, triggered also by energy scarcity and inflation, whilst China continues to battle through its transition out of its zero COVID policy. These regulations have not been friendly to domestic growth, international trade, and supply chains. Audrey, as we mentioned, this is actually all very much priced in. So what isn't, and what as investors should we be positioned for?
When we think about the US, it is often said that over the past 100 years, no bear market associated with a recession has bottomed before the recession has even begun. And this predicates and premises the dire outlook for US earnings and hence the sanguine economic and market outlook. But also a true statement at the cusp of any recession stocks have never dropped peak to trough 30%. So the question is, can you discount a recession before it actually happens?
You have to wonder. Leading indicators are already at bottom quartile levels. We see consumer confidence is in its bottom decile. CEO confidence is in its bottom decile. The yield curve is inverted, and the list goes on. As I mentioned at the start, this is seemingly the most forecasted recession in history.
And when you think about that, and you look at, say, financials especially, but also industrials and energy, which are typically the sharp end of how we define cyclically leading sectors, these are all not suggesting that we are headed into an omnibus recession.
Exactly. And remember, US inflation is coming down. Energy and food did drive inflation abnormally high through 2022, forcing the Fed to react as it has. Yet oil, which peaked at about $128, is now back at $80 per barrel. Unemployment was already at historic lows, and much of pandemic excess was manifested as unprecedented job openings. We also now continue to see a steady disinflationary tailwind driven by supply chains reconnecting and US rental housing also normalizing post-pandemic. So Audrey, we haven't talked about key opportunities or China.
Well, we did in our last episode last year. China is going through its COVID surge as the rest of the world did. As awful as it is, it will also moderate and hopefully with lower fatalities. But remember, China and Asia are sitting on multi-decade low valuations, stimulus and policy support is in play, and reopenings across China and Asia offer significant upside potential. And don't lose sight of quality investment-grade bonds. These continue to be the most compelling allocation, with yields at also decade-plus highs and the trajectories of rates also offering very defined outcomes.
Thanks, Audrey. We often say, don't fight the Fed. And very much what has been priced in has been on the back of the Federal Reserve's stated outlook. The risk and opportunities for the market now is for what is not priced in. As we see inflation moderate, arguably at a faster pace, and China's outlook improve post its zero COVID policy, these are the broader opportunities to note in 2023. Please do listen to our podcast as we dive deeper into our outlook for this year and the specific strategies and allocations worth noting. And please speak to your Citigold or Citigold private client relationship manager about further opportunities.